Hello everyone, this is Richard K from Price Action and Income, and in today's video I want to show you something really cool and that goes unnoticed by the majority of traders out there. As most of you probably know, I'm a huge fan of market geometry, i.e. pitchforks, channel lines, etc. And I primarily use these tools to try and identify the underlying symmetry that is present in the market. But today I want to do something different and show you how time also plays an important part in how markets move, especially when it comes to important highs and lows on a price chart. So today's video will not be focusing on any sort of technical analysis or strategy at all, but what I will be doing is showing the concept of repeating time ranges, or some might call cycles. Okay, let's jump right into it. Here I have a chart open on the Euro-US dollar currency pair, but note that I have set it to the weekly time frame. I want to be using the weekly time frame in today's video so that as much data can be displayed on one chart, stretching back in time as far as possible. Now, as you are all aware, a chart consists of two different axes. On the right we have the y-axis, which displays price, and at the bottom we have the x-axis, which displays time. Time is an important part of trading that many traders completely ignore, but we will be focusing on time alone today and to see whether it plays an important part on how market structure or important highs and lows are formed. The first thing I want you to take note of are these colored arrows that I drew on the chart indicating important highs and lows in the history of the Euro-US dollar. The green arrows indicated important bottoms and the red arrows indicate important tops. Now the next thing I'm going to do is open my date range measuring tool, and you can see it as some sort of ruler that measures time that have passed rather than measuring a price range. And to do that in TradingView, I simply click on my measuring tools and I'll select the date range. I then want to apply the date range to two important swings, starting from the far left of my chart, and then walk that same range forward in time to see whether that range repeats itself when measured from other important highs and lows. So to start the process, I'll start with our first green arrow, which was an important low in around about August 1993, and just click roughly onto where that low was and bring it forward to an important high. And to do that, you don't really have to be extremely accurate, but you want to get pretty close to it. And once we've selected that range or time range, I then want to see if that actual range repeats itself in the future or historically. And if I go to that high, you'll see there's not really anything over there. To this low to there, not much over there. But if I use that high over there, we nearly got a high over here. Not something major, but there was a high. We can move over here, minor high there, and just keep on walking it forward, and you'll start seeing that actual price reacts to when it hit that particular time range. The smaller you actually go in your date ranges, the less accurate they actually are. And when you move to, let's say, higher or much longer time ranges, they become more prevalent. So we can just continue moving it forward and see if this range is actually something that repeated itself. Here we have a high there, a minor low there. And if you measure to the utmost high here back in March 2008, we have that little low there. So guys, again, not major stuff happening at the moment with that particular time cycle. But here we can use that secondary high, almost close to that low. We can keep on moving forward, see if we got anything else popping up. We have that high, almost. That one over there with a minor high over there, and that high with a high over here. That was a pretty good high. And then this low actually gave that low or that high in price very accurately, using 658 days as our first time range that we're testing. What if we use that high? Not much coming in there. But here again, we'll see that a 658-day time range is working pretty well when measured from this low to this low. And let's see if there's anything from this high to that high. We also have a 658-day time range which repeated itself. So walking things forward historically, from starting from this first point back here, we can see that 658 days to some extent was an important time range to consider. So once you've done measuring, then bring that range that proved to have worked in the past to the current price action, which is on the hard right hand side of our screen, and see then whether a previous swing matches up with that range historically. And if we get that close to where price is at the moment, then we'll see that we had minor high here before this high here in February 2018, and let's just leave it at that for now, and we'll see that price is pretty close to moving into 658 days from that high over there. Okay, let's next use this important high that we had here in May 1995, and what if we bring it to this low over here, for example. And once we've selected that, let's start walking it forward. See if there's any other sort of confluence in price. We have that minor high on the left here to that high over there. Let's walk it forward. Not much happening there. With this low here to this little minor high over there. What if we use that high? Important high there gave us this high over here. Let's move it to the low. Not much happening over there. Continue moving this forward. Not much happening over there. Here we have a high over here, measured with that high over there. So the 833-day range seems to be working okay this far. Here's a good one. We have this low that came in with this low over here. Let's continue moving forward. That high, nothing much. That low almost gave us the high over there. We use the secondary low over here, then it pretty much gave us a good point to target in the upper swing that we had over there. Let's continue moving this forward, and not much happening over there in that price action. Let's have a look at this one. Not much happening there, and continue moving it forward. And as you'll see, the 833 plus minus date range is to some extent caught some minor cycles, not much happening, or that accurate as our previous one like the 658 was. But here again we have an important low, and it targets the high over there. Then once again we want to move this 833-day cycle as close as possible to our current price action again, and see where a previous important high or low came in, and here we had one, and you'll see that prices actually surpassed that 833-day marker thus far. But we'll just leave it there for now, and what we'll do next is yet again choose our date range measuring tool, and we want to progressively use higher cycles this time around. And to do that, let's start using maybe a bigger sort of cycle, maybe a low to a low. Let's use this big low we had in October 2000 to, let's say, this low over here. And just get that centered as much as possible. That will probably do. And then same thing as before. Let's measure if we can see any important previous repetitions in time cycles. So we have this low here with a minor one there, nothing major, but this is a pretty good one. We have this low over here that comes in with that major high over there, and now let's just walk it forward. This low obviously to that low, that high, missed that one. What if we go the uppermost high over there? Not much happening over there. And continue walking it forward. That's a big low with a minor low over there. That high, minor low over there. And what we've used is low. And that secondary low gave us that high over there. That high nearly gave us this low over there, which is not good enough in trading, but close enough sometimes. Not much happening over there. Let's keep on moving. That high, minor high over there. And not much happening over there. And now we're already surpassing the actual time window that price is currently trading in. But if we use that important high over here, then you'll see that there's a confluence with one of our other cycles. So let's leave the 1860 plus minus day date range as it is right now, and let's move to another higher time frame or date range. Let's go, what about this big swing? We're going to use the secondary low, maybe that was the actual low, and we want to measure that to the major low. Let's see if that repeats. Do we have anything over there? That high gave us a secondary, or that smaller low there. There we have a low to a low there. Not much happening over there. What if we use this utmost high over here? Oh, we got this secondary higher low over there. Continue moving forward, and that was almost hitting each other. We have this low to that low. We have that high to almost spot on with this low over here. We have that high close into with that low, and just move it forward again until it is close to where our actual time or price is trading at the moment. What we could also do is, what if we used a much larger time frame? Just as an exercise, we could go from that high to that high, for example, giving us 4,739 days, and step that forward and see if there's any sort of correlation. We have this low over here, almost catching that low over there. There we have that high caught with this low over here in the bottom. Oops, we have this high almost perfectly touched that high over there. And then walk it forward, and yeah, it worked in the past, but not something that worked as good as our smaller date ranges that we used. Now that we have found some important ranges and brought them forward to current price action, you will see that there is a very tight time range where these cycles created a confluence with each other. Let's zoom into that a little bit more. And for illustration purposes, let's draw a rectangle where these cycles all meet up with each other. You can leave it like that. So once I've drawn all my date ranges, and I then have to ask myself the following question. There are a lot of time ranges popping up close to a current price action. So if I was short the Euro-US dollar pair, then would I want to stay short or start to worry about a possible trend reversal? Asking yourself this question is important, because if you are already short the Euro-US dollar pair, then you should perhaps exercise some caution. Or if you were about to get short, then you might run into a low within that time zone we identified. So perhaps it would not be the best to enter a short just yet. But that's entirely up to you. I simply showed the concept of repeating time ranges today. And as long as you are aware of them, then it does make sense to exercise caution when the next important time cycle might be coming your way, especially when there's a confluence of multiple larger time ranges. But before I finish off today's video, I want to show you another cool chart on how time ranges can sometimes interact with price ranges. On my next chart, I have gold shown on a daily time frame, and I really want to focus on last year's price action in this example. On my chart, I noted last year's high and last year's low. And note that I'm using the spot price of gold and not the continuous futures contract. So I noted the high here as 1365 and the low as 1160. And that is a price range of $205 from that high on the 25th of January last year to the low in August last year, a total price range of $205. But look at how long it took before that low came in. It took 203 days. This is what's referred to as price and time squaring with each other, i.e. being very similar or equal to each other. Like the 203 days was very equal to a price range of 205 days. Now what if we walk forward this 203 days in time that it took from that high to this low and project it forward from this low here? And you'll see that price very nearly within 3 days gave us the upper high there. So if you were long into this high over here, you might have exercised some caution that there might have been a reversal lower. What I have shown you today, guys, are concepts that I personally like to include in my own analysis or be aware of from time to time. But if you are interested in exploring time ranges yourself, then play around with time cycles on your charts using a weekly time frame, and you will see that time does play an important role in trading. Some markets might work better than others, but that's just the nature of any particular market. They all have their own personalities in the way they behave. Okay guys, that concludes today's video. If you like what you've seen, then please hit the like button and please subscribe to my channel for more insightful videos in the future. Until next time, goodbye for now.